Hello and welcome to the Cash Rules Podcast. My name is Keith Smith, and I'm here with my co-host, head researcher, educational program development specialist himself,
Fabyan Rodin. Welcome, y'all.
And we are here with our guest, Cornell Sinclair. And I want to start off just by making sure that we are all aware that none of what we are discussing today should be taken as legal, financial, and/or tax advice. Instead, the objective of our conversation today is to highlight the unspoken rules in finance, to discuss why these concepts so often go unspoken, and what we can be doing on a practical level to change that reality in an informational, educational capacity. So I plan on learning a lot today. With that said, Fabyan, how are you doing?
I'm doing blessed and highly favored. That's how I feel. How are you doing? How's everybody doing out there?
Doing great.
I'm doing well.
Cool. So yeah, Cornell, if you'll just kind of very quickly introduce yourself, tell us a little bit about where you're based, what you're doing right now occupationally, and maybe some of your history if you think it's relevant.
Okay, definitely. Pleasure. Thank you for having me. Pleasure being here with you. I'm Cornell Sinclair. I've been actually in this working in this industry for about 18 years. But before I actually started here, I'm currently based here out of Chicago, Illinois. Actually, people in Chicago might take offense to me saying I'm in Chicago. I'm actually in Arlington Heights. That's the northwestern suburb of Chicago, but close enough. From the South, actually from the West and the South, born in California, grew up in Oklahoma, pretty much been all over the place. But here currently in Chicago, before I actually started working here, I actually was on active duty in the military for about 10 years. And then I transitioned out from the military into pharmaceutical sales. Did that for about a year before I actually was looking for another transition. And that's when I actually was looking in financial services, just because I really wanted to help people solve their money issues. And, I found a company that perfectly aligned with what I was actually looking to accomplish. So as I mentioned, I've been with the company since about 18 years now. I'm an investment advisor representative with the company, fully licensed in all respects. And I still do things in which I can actually contribute to the community. In years past, I've actually volunteered to do some substitute teaching at, one of the, really at-risk schools, really helping out there and also providing some mentorship with some of the young people there.
Well, that's excellent. Thank you very much, Cornell. I mean, honestly, I know you're coming in with so much experience in terms of just entrepreneur, financial coach, financial literacy advocate. And also, thank you for your service, Navy Reserve Commander. Just want to put it out there. I appreciate everything. I know our viewers do definitely as well. Just to kind of ask about what is an investment rep? What does that actually do?
Well, an investment advisor representative is someone who has actually achieved passed the Series 65 exam. So in order to actually, work in our industry, you actually have to have different licenses in order to actually operate. You just can't, get started and, start doing things. So, first thing I had to do was to get a life insurance license. I also got a health insurance license too. Overachiever, me. But no, but then I also have a Series 6. I passed Series 6 and then 63, and then the 26. I passed that just because I wanted to be free to be able to actually do different things, do networking and things of that nature. And by having that 26, that gives me the ability. I have supervisory oversight of myself, so to speak, and of course others. But then the Series 65 allows me to be an investment advisor representative. And what that allows me to be able to do for people is to help people with managed accounts. So, the Series 6 and 63 mutual funds, pretty much exclusively. Series 65, I can help people with separately managed accounts where they can actually have stocks and ETFs and bonds in that portfolio. Also, they can have, there's different strategies that we can actually employ, tactical investing, strategic investing, tax loss harvesting. So, pretty much all the things that, wealthy people have access to, I can pretty much do that with that license.
Really cool. And so I want to just make sure that we zoom out a little bit for some of our viewers. And I've also just only very recently gotten familiar with the investment advisor representative position. So I am an investor myself. So if I have a ton of money or I'm making a bunch of income and I want to buy stocks, I can go out and I can go buy stocks, I can go buy bonds, or I can potentially go to someone like yourself, right? Or how do you look at that relationship between someone who's an investor and things like that?
Right. So the way that we look at it is that, of course, I grew up, I understand that there's, we have a desire to, if we can, do it ourselves. And there's nothing wrong with that. There's some people who are able to actually, educate themselves and then, of course, have at their fingertip all the information that they need in order to make the moves that need to be made. And so, they can do that. So you can be a do-it-yourselfer. And so, of course, as you mentioned, you can actually open up an account at a brokerage and then, just, start trading or, start investing as you so desire. But, for people who, maybe they want first someone to, help them with some education aspects, because what I do is I focus on education principles. I don't really consider myself a salesperson because, what I like to do is to educate people on investment principles so that way they have a greater understanding of how markets work and how you're actually looking at things from a short-term perspective, mid-term perspective, and then long-term perspective. And then, of course, taking the emotion out of your investing. And so I educate them. And then, of course, I'm not the person who's actually managing their money. So I do help people with managed accounts, but we actually have direct access to money managers who when they wake up in the morning to when they go to bed at night, their whole focus is on managing, in many cases, hundreds of millions, billions, even, billions of dollars of assets. And they have the resources to do the appropriate research so that they know, these are some great opportunities and whatnot. Whereas, they don't just always act on just hot tips and that sort of thing. They have the fundamental information to find out, what's a great company to invest in, what are some great strategies to employ. And so we actually are able to help people in that regard.
Okay. Go ahead, Fabyan.
No, I just wanted to ask you real quickly, this is great information in terms of that. What propelled you into this field? What was that big starter for you? For somebody out there who's like, this is such an interesting topic, I'm very interested in doing something like this, or I've never heard of it. How does one find out about it?
So, going back, I guess I didn't really talk enough about my childhood and my upbringing. I was always, I guess you could say, a hustler. So I was always trying to sell something. I was selling shoes to adults. I was selling beauty products to women. And of course, I don't, I don't wear any of that stuff. I was selling candy. And, of course, that was kind of like my nemesis, because I love candy. But, I was always hustling and I was always interested in money. But of course, back in those days, I'm not going to date myself, but back in those days, we didn't actually have cell phones or smartphones and that sort of thing. So information at your fingertips. And so, the one thing that I thought of whenever I earned money is I would just take it to the bank. And, you and I both know that, the bank is good if, it's good for operational stuff, like you have a checking account and you have money coming in, money going out. Maybe you have a savings account as well to kind of, help you, with your emergency fund and that sort of thing. But banks, for the most part, won't make you wealthy. And so, the only thing that I knew about investing at that time were, savings bonds. And I was thinking, man, if I'd have known then what I know now, oh my gosh, I would be light years ahead. So I've always, had this interest in having money, but more importantly, having that money work for me. And unfortunately, earlier on, I was putting it in some vehicles that were very low return. But now, as I learned, how, I read a lot. So I read about people like Warren Buffett, and, other, Peter Lynch, people who are, and of course, people who are just general millionaires, and how they actually invested their money, and how Warren Buffett, invests. And so that I got an interest in, basically getting involved in the financial industry. And I knew that there were some steps. So the first step that I actually thought that I was going to take was to pass the CFA exam. I bombed it, but of course, it did not actually quench my desire to be involved in some way. And the only reason why I didn't actually, go back and, try to retest for the CFA is just because that's for someone who wants to be an analyst, so you're actually working on the, you're then, the money manager side. Whereas I really wanted to be more in the client interface side, and really, you don't really need a CFA for that. And so, you just need to have some licenses like what I have.
So Cornell. So Cornell, I want to stop you for a second. And let's talk a little bit. I was going to ask you about who are the money managers? So when you're looking, what does that look like to you? Who are those companies and whatnot?
Right. So that's a great question. Some of the money managers that we work with are, money managers such as, Dana Investments, RNC Genter, Sage, Meter, that's another company that, another money management company that we work with. Just kind of give you an idea, like RNC Genter, I kind of threw that name out there. They're a money management company that's, based out of, they work with Hollywood celebrities and athletes. And in order to actually be able to invest with them, if you're just going to invest outside of our company, you would need to come with, several $1 million. I want to say, I think the minimum is about $10 million in order to invest with them. But, in working with us, a person can actually only have maybe say like $50,000. So, a huge difference. So you have access to, the money managers that the wealthy actually have access to, but we just bring it to Main Street.
Okay. And really quickly, how exactly does that process work? Is there a specific account, right, for instance, that you can have with that money manager that makes that possible?
So what we do is, we will set it up where, we work with TD Ameritrade. They're currently the brokerage company that, brokerage company that we actually work with on that side of the business. And so whenever we meet with someone, and let's just say they have, a lump sum, either, 401k or, what have you, just a pot of money, then we're able to actually, directly transfer that out of their current institution into the TD Ameritrade account. Of course, if they, just sold a house or something like that, then of course we can still, have a check, obviously take a check and have that deposited into their account. And then from that account, so what we do is we have a platform. So, we have our company has a platform in which we can actually then, based upon the amount of assets that they have, we can actually, set them up with a few different money managers and with a particular portfolio focus. And then, of course, once that's laid out, then, of course, once that money is received, then those money managers will then, of course, invest that money accordingly.
Okay, so thank you for that explanation. I do still want to back up and make sure that it's super clear exactly how these relationships work. So you're the money manager. You guys work with a broker who, I guess, manages the transactions, right? And then there's also these money managers at the end of that. Can you really quickly just linearly give us that process again?
So we're the interface. So me as the investment advisor representative, we're the interface between the money manager and the client. So the money manager, the client is looking to have their money, put their money to work. So we meet with the client, determine what they're, what's suitable for them, what's in their best interests. And so we only operate what's in the best interest of the client, because we have a fiduciary responsibility to that particular client. And then, once we then, set up we know how much money that they want to invest, and then we, set up a portfolio. Once that's received, then of course, our platform will, the money manager will receive that information, and they will then, of course, invest that money appropriately according to that particular client's objectives. And this is really, of course, we have, mutual funds, ETFs on our platform, but it's definitely also, because we do actually have separately managed accounts on our platform, a person can actually say, I want to invest in X, Y, and Z company, and maybe they already have, certain assets in a given company, and say, you know what, I don't need any more. I don't want to invest more in that. And so they can actually exclude those, that particular stock from their portfolio. And so, so we can look at the entire picture. And then, of course, the money managers, they're the ones who actually, when they receive the money, they're actually investing it in those particular equities, whether it's ETFs, stocks, mutual funds, what have you. And because it's a managed account, they can make moves, pretty much as needed. So it's kind of a little bit different from like a mutual fund, because like with the mutual fund, you put your money in, it's a pooled investment, but you don't really see the goings in and the motion that's happening on a daily basis. It's happening, just that you can't see it. Whereas with a managed account, you can actually see what's going on.
So it's like basically, so in layman's terms, what you're doing is, so me and my friends have opened up an investment group, right? Mm-hmm. So basically what we are doing, so if I put it in layman's terms from an individual standpoint who's just walking into this conversation, is like, okay, I can understand the connectivity a little bit in terms of connections. But in terms of how, if we put it into real everyday life, would it actually be like, okay, as an investment group, I would go to you after I've already set up a brokerage firm like TD Ameritrade, which I actually do have, which is funny that you brought it up. And basically what you would do is kind of assist in terms of, okay, if I feel like I want to invest solely on technology, they would provide me with a manager whose expertise is technology, stocks, ETFs, and et cetera, right? Is that how it basically would go?
It would go, well, not like that. So, I mean, we would meet with the client. We can actually, whenever we set up the account, it'll set up the TD Ameritrade account for that client. So they don't have to do it beforehand. If they already have a TD Ameritrade account, basically it would just be a matter of putting us on as the broker for that account. So a little bit, so we actually have processes where, again, we can set up the account. It doesn't really matter where the money is. And typically when we're meeting with people, we're talking about people who have, their money in their 401k account. So, it may be in, most people see that their money is in their 401k account, and, they may not know, whether, what particular underlying brokerage it's in. But so we actually have all the information to where no matter, where that account is, we can actually have that transferred into the TD Ameritrade account.
So I wanted to ask, that was great. I thank you for answering me. Just to give a clarification, I wanted to also ask you, what does it mean to make money for you, to work for you? So we've always heard that lingo in terms of sleeping, and then money is being made while we're asleep, and etc. But what does it mean to you? What is that? What is that? What are we talking about there?
Right. Well, money is just a form of currency that is used for exchange, of goods. So, you use money to exchange something of value. So, let's just say there's, a phone you want. Of course, we don't have, well, people can barter, but really, we utilize, the currency to actually exchange, that money for that good or service. And so, money is something that, of course, we always, share with people that, you want to work hard for your money, but you also want to have your money working hard for you. And, the one thing that, I do talk with a number of, people who maybe their background, they may be Christians or whatnot, or they may have some sort of, religious foundation. And, that a lot of people believe in giving or, tithing, that sort of thing. But I truly believe that, if you're working hard for your money, if you're not at least giving to yourself or tithing to yourself, where you actually, at the end of the day, you have something to show for what you have just done, whether it's in a job or business. If you don't do that, then basically you're working for free. You're doing the work, but you have nothing to show for it. And we always, I always say it's not a matter of how much you make, it's how much you keep. Because the person who can actually keep, more of what they actually earn. And then, of course, if you can keep it now, of course, you can then deploy that money to where you need it, to where it can work for you. So whenever we're actually talking with, families or people, we actually tell them that there's 3 basic accounts that they actually need to have. Of course, they can have more, but there's 3 basic accounts that they need to have. The first account is they need to have an emergency fund. And then, and that's something that it's a you put in, but you don't take unless it's an emergency. And then the second account that you need to have is your wealth building account. And for a lot of people that work a job, that can be a 401k, a 403b, 457. But then even, after you're, fully contributing, or you contributing up to a match, because if a company is offering a match, you got to take that free money. You got to take the free money. Then after that, you can also invest in a Roth IRA. Of course, people above a certain income amount, they can't contribute directly to a Roth IRA. However, there's a backdoor way in which you can actually contribute to a Roth IRA, where you contribute to a traditional IRA and then, of course, convert that to a Roth IRA. That's not a problem. It's just a minor administrative process.
Okay, so talk to us a little bit about what are the benefits of a Roth IRA?
Benefits of a Roth IRA is that right now you can currently contribute up to $6,000 in a given year if you're under the age of 50. And then over the age of 50, you can contribute an additional $1,000, so $7,000 to a Roth IRA. The great thing about a Roth IRA is that the money that you put in there, it grows tax deferred. And when you take it out at retirement, it's tax free. Now, as I was mentioning, we advocate that people have an emergency fund because emergencies are going to happen. And if a person doesn't have an emergency fund, if they're just putting all their money into a wealth building account or, long-term accounts, and the emergency happens, then what we see is that people actually have to raid their IRA. And, now the thing about that is that you can't deduct your contributions to a Roth IRA. However, you always have access to the money that, to your contribution at any time, no tax, no penalty. Of course, that will take it will reduce the amount of money that you actually have working for you. But again, there's no penalty for you to actually access your money if you need to. And then, of course, the great thing is that when it comes to retirement, it's tax free. So it doesn't really matter what tax bracket you're in. It's tax free. So when you take a distribution from that after you're over the age of 59 and a half, then it whatever you take from it doesn't have to get included in your taxable income whenever you file your taxes. Whereas the same is not true with a traditional IRA. You would have to actually put any distribution on your tax filing form. So in that way, it can be factored in and you can pay the appropriate taxes on that.
Okay. So I just wanted to really explain the Roth IRA because it's a very powerful tax vehicle for wealth growth, right, over the long term. So just really quickly, Peter Thiel, I don't know if you're familiar with that story, but he's one of the most successful sort of users of this concept. So when you're contributing to the Roth IRA, you don't just have the ability to contribute cash. You can actually contribute assets to your Roth IRA. And in his case, he's the co-founder of PayPal.
Yes.
And so in 1999, he had bought 1.7 million shares of PayPal, as I guess he also bought them at this point. And then that was about $1,700 at the time. So he was able to put 1.7 million shares of PayPal into a Roth IRA, which today is the equivalent of about $5 billion, which is now all withdrawable at a tax-free rate.
Correct.
Right? So at that large level of growth over the long term, when you have, a private asset or even just something that can grow in such a way, it can be an extremely powerful tax vehicle. So I just wanted to kind of put that out there as well.
That's correct. That's correct. The Roth IRA is just a vehicle, a tax shelter, if you will. You can put whatever vehicle that you want in it. So individual
Yeah.
stock, ETFs. You can even put bonds in there. I wouldn't. Well, you could. No, you could. But and of course, I believe you can also. I believe they're even starting up. You have crypto and as well. But
Yes.
in the case of Peter Thiel, yes, you can invest in a private company. People who have their self-directed IRAs, they can do those things as well. And the thing about that is, his example is what that actually should have been a shining light of. This is actually what you really should be doing is in your IRA, have some part in which you just say, you know what, let me just put something. It might be a little bit of a flyer, and of course for him, he kind of knew what was going on, but you want to be able to have a great upside, because the whole goal is to grow your money. And again, I applaud him for what he did. I don't understand the backlash that I have actually seen, because of that. But that's a great thing. So the Roth IRA, but here's the thing. Here, I kind of want to take a step back, because I know we're talking about investing, but for the most part, when it comes to investing, I know many times we approach investing as it's just a thing to do. But to me, you have to really invest with an objective, because, I like to say, like whenever I'm meeting with people, I use different stories to kind of convey some information. I think I kind of mentioned to you that, when I look at investing, I look at investing the same way as if I was going to take a road trip to somewhere that I've never been. Now, it's different if you've been somewhere. You can probably like, if you have a sixth sense, you can probably blindfold yourself and drive yourself there. Although I wouldn't recommend that. But if you've never been to a certain place, then you would have no clue, what direction, what highways you need to take, how much fuel it's going to take you to get there and whatnot. And so a lot of people are saying, you know what, I want to retire someday. And they're saying, okay, I want to retire at a given age. And then they leave it at that. And then they start, you start investing. But, the thing is that whenever you set that time that you want to retire, that's the same as you saying, I want to take a road trip from here in Chicago, and I want to go to, say, I don't know, I'm trying to think of a place that I've never been, but I've been a lot of places. So I want to go to Lawton, Oklahoma. Now, people know Oklahoma, in relation to here is, I got to go Southwest. But for the most part, if I've never been there, then I would generally know that I have to start Southwest. But in order to really get there, I would actually need to know the specific, a highway to go and that sort of thing. And so whenever a person is taking a road trip, in the old days, we would actually have a physical map, atlas, so to speak. But today we all have smartphones and GPS and, Waze and Google Maps. And that actually will tell you how, the particular route that you're going to take, how long it's going to take you to get there. And then, of course, you can figure based upon your gas mileage, or, if you use an electric vehicle, how many charges or how many refills it's going to take you to get there. But when it comes to retirement, we can actually find out a person's financial independence number. And really, that's the destination. And then, of course, break it down on a monthly basis, how much a person would need to save, or how much gas they would need to put in order to get to their retirement, based upon a given rate of return in that particular vehicle that they're investing in. And so that's where I kind of start, and talking about investing, that it's a destination, and that we need to, of course, have the appropriate tax shelter. We need to have the appropriate vehicle, and of course, we need to put enough gas into the vehicle in order to get to that destination.
Can I ask a quick question? I know we talked about ETFs and stocks and just in pure hindsight and just overview. If I can give you 30 seconds or less in terms of just kind of explaining the difference between or defining what is an ETF or what are those stock options in terms of trading, et cetera, just to kind of give a little background for those who are just, listening to our conversation.
Okay. So, ETFs, they're exchange traded funds. And what they are is, it's kind of like a conglomeration of stocks that are, traded on an exchange. And with the exchange traded fund, an ETF, you can actually move in and out in the same day, making moves in and out. Whereas with a mutual fund, you buy a mutual fund, they execute it at the close. And then of course, if you want to sell the mutual fund, say early in the day, because you saw, something happening, well, it's not going to execute until the end of the day. So ETFs allows a person, or a money manager, the ability to really take advantage of volatility. I know that right now, a lot of people are a little unsettled by the volatility that is occurring. But, really, this is where a lot of money is made because, when you have those large swings, a money manager can actually, make those moves to, buy in. So if we're talking about a separately managed account, buying into a particular stock, or if we're talking about the exchange traded funds, buying in and then, of course, executing trades. And of course, getting those gains. And of course, if those are in a tax deferred, a tax sheltered vehicle, then those ins and outs don't contribute to your tax, your tax consequence. It doesn't have a tax consequence in your current tax year.
Okay. So
I'm sorry, real quick, Keith, I wanted to kind of just one more question onto that, which then brings up the following question, right? So we talked about ETFs and stocks because, it's a series. I think the next two set up in terms of how I'm going to set up the questions is, Cornell, if I'm new to investing, what type of trading is there for me, or what should I kind of go to? Because I think a lot of people look at the Wolf of Wall Street, or in those type of movies or shows, right, or type of books that they're reading, and they're looking at it in the sense of they might be confusing what we know as day trading or option trading to regular trading. So if you can give you a brief overview in terms of what type of trading there is when it comes down to stock.
So I don't directly, so even though with our money managers, they can actually invest in particular stocks in the separately managed accounts, I'm not the one who's actually trading in those particular stocks. So, so whenever we do set up a separately managed account, they can actually say, what, I would like, these particular stocks to be in there. And so the money managers, it depends on the investment style that they're actually employing, whether we're talking about tactical, meaning they move in, they move out as need be, or strategic, where strategic is synonymous with long-term buy and hold. Whereas tactical is, basically making moves according to market fluctuations. Okay. But in terms of, did I answer your question?
Yeah, it actually did. I appreciate that. And to a sense, I wanted to kind of, I guess the next question would then be, what are some of the biggest lessons you learned in your career working with individuals?
Yes. So, the biggest lesson that I learned is that, I forgot to mention that I was in the nuclear power program in the Navy. And so, of course, studied.
How could you forget that, Cornell? How could you?
Well, I also forgot to say that I was a valedictorian of my high school class too. So I just didn't want to, hype myself up too much.
Many accolades. Understand.
But when you're thinking about physics, you know that when it comes to a body at rest tends to remain at rest unless acted on, and inertia. that's inertia. And so when it comes to, things that, habits that we have, whether it's, saving or investing, typically we like to just put something in place and we don't, really want to make any sort of change. And the thing about that is that when it comes to, arriving at a destination, like I mentioned that I was in the Navy, or well, about to be out, totally. But in the Navy, of course, when you're sailing on a ship, and I was a ship driver. Whenever we would set out, say from San Diego, and we were headed to Hawaii, we would chart a course. And the one thing that we always knew was that, you had the currents working against the ship, and you also had the winds blowing you off course. And so our quartermaster would always take a fix, and he would say, okay, where we are along the intended track. And then they would, plot the fix, and then to see if we were off course. And so then, of course, we knew where we were. We would then adjust course to get back on track. And when it comes to investing and reaching your one's goals, that's something that, definitely does require, at least, annual visitation, but also just, people, sometimes we find that people fear what they don't know. And so, if a person doesn't understand investing, then, we find that, they may actually invest, in a 401k, but outside of that, they don't have a Roth IRA, or they don't have any other investments for goals for like education or buying a house or that sort of thing. Basically, they you put it in a bank account. And the thing about that is that, once you understand investing, and you understand, that there are, appropriate vehicles in which you can actually invest for the long term, and then also you can invest for medium range, then that can actually really help a person. And then also the other thing that I've actually learned is that, excuse me. The other thing that I've learned in my career of working with individuals is that, trust is a big thing. And that's the one thing that, I always like to say that I like to treat people the way in which I would like to be treated. And so, I would hope that, that care and that concern, is conveyed, that, I only really want the best, for, the person that I'm meeting with and working with. And then, some of the other biggest lessons that I've actually learned is just really the time value of money. I've also learned, the power of compound interest. Those are just some of the things that I just really, I've learned that, really make a big difference. And it's something that, when it comes to something like the, compounding interest or the time value of money, I've learned that, as, people or individuals, sometimes one of the biggest hindrance that we may have to accomplishing certain goals is something called procrastination. Mm-hmm. And I know that, if we're talking about a young person, we always, I'm talking about myself like I'm a young person. I'm still kind of young, but a young person, you might hear a young person saying, you know what, I'll get started investing. There's going to be plenty of time, a little bit later on down the road. And, even if they let 1 or 2 years pass, that's a big difference. And we do show people, what sort of difference, that sort of delay can actually have in their total return, procrastination. And then, because when it comes to the time value of money, one of the things that I was really shocked about was, I actually have, a wide range of clients. I have some people that I started working with when, the parents that they had a child that, they had children that were, young, who had actually earned, income. And of course, had actually done like pretty much anybody would do. You earn money, whether it's cutting yards or modeling or
selling candy or even, bottles of water.
Exactly. You're going to take that money, you're going to put it in the bank in a savings account. And we know that right now, bank savings accounts are returning less than 1%. And, the one thing that, when I, was meeting with a client who, when I asked, I just asked a question, and she told me, and I was like, wow, that money could be invested in a Roth IRA. Of course, the bank just had it in the savings account. And so we basically took that money and invested it in a Roth IRA. And, that money did, it's more
doubled
than,
or
doubled.
quadrupled or something like that.
So I want to dig deeper into this concept a little bit around just like the time value of money. And
yes,
Cornell, before we had this conversation, you talked about the rule of 72. What is the rule of 72? And how would you explain that to someone who knows absolutely nothing about investing?
Right. That's a good question. So, when it comes to investing, like I said, investing should be entered in with an objective in mind, not just something to do. And so the whole goal, your whole goal whenever you're investing is you want to basically double your money. Again, I go back to the Bible where, it talked about, the talents. The three guys were given talents. One person was given 1 talent. The other one was given 2, and another one was given 5 talents. The one with 5 talents went out and, doubled the talents, came back with 10. The master said, hey, well done, good and faithful servant, and then the one with the 2, he went out and doubled it, came back with 4. He said, well done, good and faithful servant. But then the one who only had the 1 talent came back, he dug a hole in the ground and hid it, and then, brought it back and said, here's your talent. And, that's not doubling your money. And so, of course, the master took that talent from that person, banished him, and then, of course, gave it to the one that had, returned the most. So that person could then actually put that to work. And so the rule of 72 is just a great, simple way to approximate the number of years that it will take your money to double at a given rate of return. So, let's just say, you invest in, say, something achieving a 3% rate of return over a period of time. Then you take 72, you divide 72 by 3, and that tells you that it's going to take approximately 24 years for that money to double, right? But then let's just say, you have something that's returned, say, a 6% rate of return. And so you divide 72 by 6, and that shows you that it's going to take about 12 years for that money to double. But then you say, you know what? I know that, there's something else that's out there, excuse me. And you see something that's returned a 12% rate of return. And so you divide 72 by 12, and it's going to take your money six years to double. So I don't just speak in terms of percentages, because for most people, they really, I would say, what's the big deal between 3 and 6 and 12%? So I like to dollarize it. So let's just say, you have a friend, a female friend, or, a couple, and they're going to have a baby. And of course, as you know, everyone who has a baby is going to throw a baby shower, right? So, in most cases, for a baby shower, most people are going to bring, different things that, after the baby is like over a year old, they're not going to be using that, that particular thing anymore. But let's just say if, everybody came to this baby shower and say, you know what, we're going to bless this baby with $10,000. Okay. So they bless the baby with $10,000. So now that those parents are looking and saying, okay, where do we want to, put this money? We want to put it somewhere, but we don't want to lose it. So, first they look at the 3%, option. And so at year 0 is $10,000. Takes 24 years for that money to double. And so they don't touch it. When the child is 24 years of age, that now is now $20,000. And then, if the child says, you know what, I don't need that money, let's let it keep working. And so then another 24 years pass. At age 48, it's $40,000. And most people will look at that and say, man, that's pretty good. I mean, you started with $10,000, you ended with $40,000, you end up with more money, but did you really? Because, the rate of inflation historically has been about 3.5%. So if we think about that 3.5% inflation, and you only got a 3% rate of return, you actually lost purchasing power, in that bucket right there. So the parents say, you know what, okay, let's go a little bit more aggressive. Let's go with the 6%. And so they invest that $10,000 in the 6% bucket. So at year zero, it's $10,000. It's going to double every 12 years. So when the child is 12 years old, it's $20,000. When the child gets 24 years old, it's $40,000. And so you can kind of see it, it's, at that point, it's about double the other one. And then you go on another 12 years, 36 years, it's $80,000. And then at age 48, it would be $160,000. So, right there, you doubled the rate of return, but you ended up with 4 times more money because there were 4 more doubling periods than on the 3%. So now let's look at the 12%, real quick. 12%, 12% is doubling every 6 years. So, every 6 years, that money's doubling. So, age 6, it's 20,000. Age 12 is 40,000. Age 18, 80,000. Excuse me.
My question to you, Cornell, and this is all great information. And obviously there are many rules, right? There's a rule of 69, there's a rule of 42, rule of 32, rule of 39, 37, etc. And these are many other rules. Where can somebody find out about this stuff? Is there any resources, anything like that you probably went through in your time where it's like, hey, listen, these are the top 3 websites or top 3 books to read or something like that, or kind of discover? What would you kind of consider such fuel?
So, of course, I didn't learn any of this in school or anything like that. Now, I will say this, that, there are schools that are actually now starting to, include some sort of personal finance education, but really it's very focused on the basic and I didn't really see that, something like this, the Rule 72 was something that was there, but we do actually produce a publication that we do distribute for free. And it basically covers all the financial principles. It's not designed to, sell anything or be a solicitation of a sale or anything like that, but basically
it's just to educate.
It's just to educate. And we provide that free of charge to anybody who contacts us and wants that information. So like whenever I do conduct webinars or not webinars, but, seminars or financial wellness seminars, I do actually make that available sometimes in print, but, definitely in PDF. But, the 12%, just to, close that up, that $10,000 would have actually at 48 would be about $2.5 million. So that, that's a huge difference.
That's huge. That's a huge difference. I know we went over a little bit of the licenses that you had in education, but if somebody wanted to jump into this field, like you're doing here, what is the one track you think that they should actually go on to? I know we talked about the education a little bit before, but like, hey, is college something that you prefer them to go into? Or should we just go into straight studying in terms of a license?
Right. Well, college is one route that one can take. However, college is not necessary in this industry. In this industry, the financial knowledge, that's one piece. And, of course, if you're going to work with the company, your chances are you're going to learn the financial concepts and principles. But really, the big thing that I find that helps a person be successful is in, self-development, personal development, and also in the area, in all areas, whether it's leadership or, how to relate to people, different things like that. So I'm reading a book pretty much every day. Well, not a different book every day, but I'm reading a book, each day. And so, personal development. But, in terms of actually, entering into this industry, it really doesn't require a college degree. Now, there are some companies that will say, it's highly recommended, but not all companies require a college degree. And in fact, a person can actually just, you can actually have a GED and actually start working in this industry. Now, to get those licenses, you do have to pass, standardized exams. And so the exams, it doesn't matter what company you're working for, or even if you're independent, the insurance exam, that's on a state level. the securities exams are on the federal of, administered by FINRA. And so, so you have to take those exams and you have to pass. I want to say that it's typically, in some cases, a 70% mark, but I know with the Series 65, it was a 70, I think it was a 72, 73% mark that I had to achieve in order to pass that. They don't tell you if you scored 90, you don't really know how well you passed. They just tell you pass or you fail. Right now, they used to do that, but you pass those exams. Now, those exams are the way to look at those exams. I look at those exams like, if you're going to drive a car, you have to have a driver's license, and so passing those exams basically gives you the license to work in this industry and to be compensated. But in terms of actually, learning all the ins and outs of what we do on a daily basis, I'm pretty much certain that every company has a training program in which, you come in. I know that me personally, I'm actually attentive to training with my office on a 6 days a week. So 6 days a week, I'm receiving at least 30 minutes of training from my office, and on weekends it's about an hour and a half or so.
Wow, that's interesting.
I want to kind of bring us into the last section of the podcast here, where we just do a really rapid round, where in less than 30 seconds, I want to get the answer to a few of these questions.
Gotcha.
So you mentioned one of the properties of money, that being, I think you did the unit of account or means of exchange. Sorry. So the means of exchange is one use for money. Another use is the unit of account, and then the other is a store of values. So
correct.
Tell us, with these properties of money in mind, like, what does money actually mean to you in under 30 seconds?
What money means to me is it means, the ability to be able to do the things that you want to do. And then of course to have, freedom. And how I think about that is, if you don't have enough of it, you're not going to be able to do the things that you want to do, and you're not going to have freedom. But if you have sufficient money, then you're going to have the ability to do whatever you desire to do. And then you're going to have the freedom to do what it is that you desire to accomplish.
Very cool. And then tell me, what is your favorite book or favorite books that you've read?
My favorite books that I have read. So I'm starting to read Atomic Habits. So I can't say that I've read that one yet. But some of my favorite books are, of course, Think and Grow Rich.
And who's that by?
Think and Grow Rich, Napoleon Hill. And then, of course, I read the whole Rich Dad, Poor Dad series, just understanding the difference between, being an employee, a self-employed, business owner, and investor. And, again, there's nothing wrong with being an employee. There's nothing wrong with being self-employed. It's just that whenever you're looking at, where the money is, 90% of the money is actually on the side of business owners and investors, whereas 90% of the people are on the side of employee and self-employed. So, so you kind of want to be where the money is. And if you're not there, then, you're going to have the situation where people are always saying, man, the rich are getting richer and the poor are getting poorer, which is not entirely true. The poor are also getting richer in America. When you compare, the American, socioeconomic status compared to some other countries. So.
Very good. Very good. And then tell us, do you listen to any podcasts? Do you have a favorite podcast that you listen to?
Because I'm the interface between, clients, pretty much, I wake up in the morning, and
you watch Cash Rules podcast, don't you?
Well, I do now. Cash Rules podcast. But again, I wake up and I'm reading. I'm visualizing my goals and whatnot, and then of course I'm focused on talking to business owners and individual people each day. But yeah, Cash Rules. Definitely. Definitely, listening on those things.
Thank you so much, Cornell. I think this has been a great episode. We've definitely got a lot of information just around context of how the financial system works and your role in it as an investment advisor, and also just some really cool financial concepts like the Rule 72 and so on. Tell us, where can we reach you if we want to reach out to you?
Of course, a person can reach out to me. I do make myself available the old-fashioned way. Yeah, a person can actually call me. Telephone number is 847-275-5711. But I do also have a web presence as well. With my company, Primerica, you can go to primerica.com/Cornell Sinclair, and that's spelled CORNELLSINCLAIR. I also have a landing page, livemore.net/C Sinclair, and that's Charlie C. So kind of a play on the word C Sinclair.
Very cool.
But yeah, okay. And then of course you can also just go to primerica.com as well, and that's where you can kind of just see some of the different principles that we advocate, and to help people to accomplish financial independence, debt freedom, and that sort of thing. And then of course to kind of see if a person wants to check out a company, definitely can check out and see what the stature of this company is all about.
Amazing. Thank you so much, Cornell. I think this has been great once again. And Fabyan, you got any closing words?
No, as usual, if you ain't reading, you ain't going forward. Please do your research. Thank you, Cornell, for being here. Thank you, Keith, as always, and establishing these connections. This is awesome from an education standpoint. I think we learned a lot. I've learned a lot. I think our viewers learned a lot. And thank you for sharing your phone number as well as where everyone can reach you at. Blessing salutations to all and to all. Good night.
Until next time.
All right.